Hi, I'm Grace, and I'm going to be walking through the Forma Agroforestry model that the Cash Coalition has spent the past few months developing. So before we get into the model itself, I wanted to quickly walk through some of the goals of the model. So the first goal for the model is just to understand the underlying economics behind agroforestry projects. We wanted to understand what thresholds need to be met to make these projects financially viable, but also what variables have the most impact on project economics. So this is meant to be for project developers, financiers, NGOs, anybody in the space who wants to understand what's actually driving the financials of these projects a little more closely. Then the second goal is to give project developers a structure for a financial model that they could actually bring to financiers. So we're hoping to be able to give this to project developers and have them be able to adapt it to their own purposes, add to it, and create a really robust financial model that they could then bring to financiers to get grant financing, loan financing, carbon offtake, etc. Then the third goal is really to educate financiers themselves on the economics of these agroforestry models. We wanted to give people a tool to actually be able to see how impactful financing can be on making these projects financially viable. So the idea is for people who are giving loans, giving grants, participating in offtake to be able to go into these models and really understand what their financing is doing for the project and to understand sort of how their financing is making the project economics work. So let's jump into the model itself. I'm going to quickly move myself over here. So the model starts out on the summary tab. So the purpose of this tab is really to give people screenshots, quick digestible bits from the model to understand the fundamentals of the model's outputs. It starts with this program overview section. This gives the total number of participants in the program after the enrollment period is finished, the total number of hectares. It also gives carbon sequestration on a per adapter basis and a total program basis. Down here it has the payback period, so this is the year where you have made back all of the money that you've spent on the project and you are now breaking even, you're in the positive. And then this break-even year gives the specific year that your marginal revenue first exceeds your marginal costs. These graphs give a general program overview. We have total carbon sequestered over the lifetime of the project. We have the total cost per credit issued, so you can see it's really high at first, and then as more and more credits are issued, but cost per credit drops off over time. Then we have total annual program cost. So this is the program cost per year. You can see it increases pretty quickly as project adopters are added to the model. So this is showing an exponential increase in the number of participants through year 10 based on a specific growth percentage per year. And then after that, costs generally just increase in line with inflation. Then down here we show the impact that that program growth rate has on the developer NPV. So this is financials from the developer perspective. You can see over here that the project doesn't really become economically viable under these conditions until you hit almost 11,000 participants. It becomes financially viable a little bit earlier if you increase the number of participants up to about $15,000. And from there, the projects just become more expensive in the early years to implement because you're enrolling so many more participants. But in the longer term, they become more and more financially attractive as you enroll more participants. This next section gives some of the net profits and returns. So it shows it on a per adopter basis. It shows a full program basis. And then it shows what financing can do for the projects. So this section doesn't include financing. This section does include financing and carbon offtake. So you can see how different financing scenarios improve the project economics. This is annual adopter net profit on a per adopter basis, and then this is the net profit to the developer under some of those different financial scenarios that we'll walk through later in the model. We don't need to talk through this revenue section in a lot of detail. It basically just gives several different revenue breakdowns. So you can show where the revenue is going. Is it going to adopters, developers, carbon brokers, or to the governments? What exactly is happening with the carbon revenue profit sharing, where funding for the project is coming from in terms of carbon offtake grants, and then just general non-contract, non-offtake carbon revenue. And then we have very specific revenue breakdowns for adopters. So that's it for the summary tab. Next we get into how the model actually works. The model uses this assumption tab for all of its inputs. So we have the regional data section up front. Right now, all of the project economics are based on a 1 acre fund project in Tanzania, but the eventual goal is to have different project developers build out different regions, different project types that could then be toggled in between up here using this toggle. The entire financial model uses this color key, so you can see things that are just plain inputs, so numbers that you need to type in, are all gray. Something that is a calculation, like for example, you can see the program fee down here is currently referencing a calculation on another tab. That is something that can be changed, but is not just a simple input. And then these green, the lighter green things are toggles, so areas where you can change between several different options with a drop-down menu. Then this teal color here, that represents technical inputs. So those are inputs that need to come directly from project developers based on either on-the-ground data or advanced agroforestry modeling. This model doesn't adapt to technical inputs in a very specific way. It's much more financially focused. So you need to put in technical inputs on a project level, which we'll talk through in a little bit. So down here, these white cells reference most of the assumptions up above that are changed as you toggle through the regions, but it does have some carbon inputs here. So we have, for example, a buffer for carbon projects, there's an uncertainty reduction, how many fruit trees are being counted for carbon projects, the same for shrubs. Some of the costs associated with implementing carbon projects are here. Those all need to be changed and can be updated for different project types. Now, down here is where we get to the actual program design. So this is where we have the annual program growth, the output of which we were looking at on the previous summary tab. Then we have the initial participants, we have the enrollment period, so you can see if you change this to 15 years, the number of new farmers increases through year 15 and then stops at year 16. Then we have the species mix. So this is inputs of several different species. It calculates survival rates and replacement rates, as well as the space of crops displaced. So there is an approximate meter squared occupied by tree that is compared to current crop area cover and calculates a total displaced crop value. So this is some of the opportunity cost of farmers for participating in a project like this. Then over here we have sensitivity analyses. All of these are broken out more clearly on the summary tab, but this is the origin of those data tables. So if you need to input new data tables to run sensitivity on some of the variables on this tab, this is the section where you would do that. Next we have the carbon pricing tab. So this tab gives the user the ability to cycle through several different carbon pricing scenarios. You go to this toggle up here and can switch between a fixed scenario, which has just one fixed carbon price that you would input here, an exponential scenario where you have a fixed starting point, but then there's some annual percent change every year. Right now we have it set to 2%. And then the ability to cycle through a few different carbon pricing scenarios. So these scenarios are outlined here at this link. They're based on some Bloomberg analyses, basically around different levels of optimism and validity in voluntary carbon markets. So you can go to this link to read more about those scenarios, but we've broken them down into Scenario 1, which is the least cost decarbonization scenario. So firms are just pursuing the least cost option for decarbonization. We have Scenario 2, where carbon market validity is high, there's highly inelastic demand for offsets. And then we have Scenario 3, where voluntary carbon markets are not perceived as valid, there's highly elastic demand for carbon credit pricing, and you can see carbon prices only go up to about $16 versus in the high 200s for scenario 2. So I've left it on exponential for now, but you can toggle through those different options, and these numbers can also be updated to individual project developers' carbon pricing models. You would then just need to, you would update these numbers in this row, or in any of the rows of the scenarios, and then go to change the scenario up here to reflect whatever scenario you want to input for your project. So this tab is where it starts to get into the actual meat of how the project economics are broken down. This tab takes the adopter perspective, so it looks at the project on a per adopter basis and calculates cash flows for individual adopters, and then for project developers on a per adopter basis. So this is where a lot of those technical inputs become really important. The way that this model works is it has revenue broken out based on different species that are in the agroforestry model. So you can see for Grevillea, for example, here, we have the units of firewood that are produced for the tree, the price of firewood, and then as a result, the total firewood revenue that comes from the Grevillea that is planted. Then we have the same for total carbon sequestration per tree, and these teal inputs are where a project developer would need to input specific per year values based on that individual agroforestry model. Down here we have the same for shrubs that produce fodder and for fruit that is produced. So right now we have, I believe, avocado, lemon, mango, and then there's a moringa option down here where it calculates leaves and seeds produced based on prices. So all of these revenues are summed up into the total non-carbon revenue bucket. If you wanted to add a species to this, you could either just change one of the species here on the assumption tab and then go through and change all of the relevant metrics along the whole line, or you could add a new species and then add a section here with each of these inputs to calculate additional revenue from the new species. You would just need to make sure that that new species is included in total non-carbon revenue here, and make sure it's included in the sum of that. So then below it gets into carbon revenue. It sums up all of the carbon values that you've input into these technical input areas, multiplies it by the species number that you specify on the assumption tab, and calculates a carbon revenue number. On the first tab, there are a lot of different project parameters you can adjust to change when you actually issue credits. So you can extend the credit issuance periods. You can say, we're actually not going to be ready to issue credits until year 5. You can limit it to just year 5 to 20 of the project. There are a lot of different things you can change that will all change this credit issuance year. Then it sums up those two revenue streams and adds in costs. So these are the costs to farmers. This is the only thing that needs to be directly input. Everything else changes on a per year basis based on some of inputs from the assumptions tab, but the participant opportunity cost actually needs to be manually entered in by project developers or financiers so that we can understand exactly what the opportunity costs are for this individual population of farmers. Then down here, there are revenues. These are all directly pulled from the section above. Then CO2 revenue is added in. This model has a guaranteed surviving payment per tree to farmers, but you can set that to 0 in the assumption tab if that's not part of your specific model. And then we have the profit sharing percentage per farmer. It's calculated how much profit will be shared with the farmer from carbon revenue, and then it sums it up into total revenues. Then all of those cash flows are shown just from the developer perspective here. So how much they're paying per seedling, how much they're paying to the farmers, what their admin costs are, etc., etc. So from this tab, the individual adopter tab, all of those project economics are rolled up into the program impact tab, which is shown here. So this takes all of the participant information, so the number of participants and the number of participants that are added each year, and calculates the project economics on a full project economic basis. So it has the total carbon sequestration for the project as farmers are added. It has the total credits that are available based on that buffer pool reduction that I showed you on the assumption tab, and then how many credits are actually made available. So that's minus buffer, that's minus any kind of insurance that you've taken out. Then we come down to the net credits that are actually issued for projects per year based on new adopters. And then that comes down to the total number of credits. So this is the total number of credits issued on a whole credit basis, since we've assumed that you can't issue partial credits. Then the carbon price is pulled in from the carbon pricing tab to calculate total project revenue for carbon. Down here we have the total number of trees surviving just as a sort of bonus metric. This doesn't feed in anywhere in the project other than those payments to farmers, but it's a nice metric to be able to pull out. Then we have the adopter cash flows on a full basis. So we have how much adopters are paying in tax, total adopter costs for the program besides tax. Then we have total adopter revenue this includes all of the fruit revenue, all of the firewood revenue, fodder revenue, everything that's included on the Forma page plus carbon. Then the developer cash flows. So this breaks down what developer costs are and what developer revenues are as the program expands. So we have admin costs, we have those guaranteed payments to farmers, we have seedling costs, we have free, prior, and informed consent costs. So that is what developers are having to spend to make sure that their project is being done to FPIC standards. Then we have staff costs. This model has it broken out into total variable staff costs, total fixed staff costs, but then also assumes that some portion of total enterprise or total organizational costs are attributed to this project. So that's what these two are. Shared overhead and then global support costs both reflect the amount of total organizational cost that's being allocated to or assigned to this project. Then we have certification costs for actually implementing the carbon project. Then government fees and charges. So this includes taxes, revenue sharing to the government, etc. from the developer perspective. Then all of these are summed up to get to a total cost number. The program fee is revenue from farmers to the developer. So this is what participants are paying to actually participate in the program. And then we have total developer revenue. So that is based on the program fee, but also the carbon credits that are issued. So you can see here in year 0, when no credits have been issued yet, the program fee is equal to the developer revenue. But after that, carbon revenue is added in. Then here's our IRR calculation, and down here are break-even and payback period calculations that are referenced on the first tab. So these cash flows are project economics without any kind of financing. The last tab shows the impact of financing on these projects. So we have a summary of the financials that are shown in the previous tab. So this is really just a consolidated version of the cash flows that are in the previous tab and should be exactly the same minus carbon revenue offtake. So here you can see CO2 revenues. This is assuming a scenario where there's no amount of fixed offtake. This is only carbon if it was being sold on the open market, assuming carbon prices are what's reflected in the carbon pricing tab, no kind of offtake contract. So this IRR and NPV, these numbers are really meant to represent a scenario without any kind of financing. So the first section here shows an offtake contract financing scenario. We have the total volume and offtake that is going to the offtaker. We have their pre-purchase price, so this is assuming that a certain amount is purchased at a fixed price. Then we have the year that contract starts. Right now it's starting in year 1 and ending in year 20. So the offtaker takes credits for 20 years, and after that, credits are sold on the open market until the end of the project. Then we have the structure of the contract. So is it a fixed contract with credits going to the offtaker every year until the total volume of credits is met, or is it an upfront contract where there's an upfront credit balance that is expected to be paid to the off-taker? The off-taker pays the full value of those credits up front, and then the developer gives off-take to the off-taker over the project lifetime. So you can see this shows all of the revenue from off-take occurs in year one versus the fixed scenario where it occurs as credits are accrued to the developer and are sold to the off-taker. Then we have the IRR and NPV for the project with an off-take scenario. So this doesn't include other types of financing. This is with an off-take contract. Down here, we have grant financing. So there are two different ways to input grant financing. You can either have a percentage of costs covered by grants over a certain number of years, let's say 5 years. Make sure you delete that out. So this is option number one, based on a percentage of costs. You can see here the total grant value comes from that percent of costs for the first 5 years of the project. And it calculates remaining costs after grant financing comes in. Or you can have a total grant value. Let's change that back to $1 million. Make sure you delete out these two inputs. And this shows a $1 million grant upfront that is spent down until it runs out. So you can have either pricing scenario or either financing scenario for grants. Then this shows the IRR and NPV after offtake and grants. So each of these financing scenarios are additive. So if you want to see a scenario with no offtake and only grants, you would need to go up here and delete out the total volume in tons for the offtake contract to show that there's zero coming from offtake. This is only funded by grant financing. Then down here, we have loan financing. So again, this is additive. This assumes that whatever grant value you receive has already been added to costs. So there is an option to enter up to 3 loans here. I have the first loan is currently in there, but we can do another sample loan here and it will be added to this section down here. So let's assume interest rates dropped recently. Let's say it's a slightly lower percent interest. We can have the same total volume of loan provided. Then loan term for years, let's say it's a 20-year loan. And then there are several different payback options for how the loan is paid back. So the first one is a straight line payment schedule. So you pay down the same amount of your principal every single year. You pay interest based on how much is remaining on that principal. Then there's a mortgage payment option where you pay the same total amount every year that you would, just like for a mortgage, but you're paying more interest up front and less principal, and then as you pay down the principal, your interest goes down. Eventually you're paying more on the principal than you are on interest. And then the last option is a debt service coverage ratio option. So this enables you to pay back the loan as you earn profits. So you have to be able to cover the interest payment, but then how much you pay in principal is based on how much money you're making. So you can see here, the first payment doesn't actually come in until the project becomes profitable enough to start paying back the loan in year 12. And that is based on the debt service coverage ratio. So that's a ratio of revenue to how much you're having to pay in debt. So this ensures that you always have to have 1.5 times the volume of revenue as what you're paying down in your debt. Then you can add another loan here. I'll leave that blank for now. Down here we have IR and NPV again. This again is additive, so this IR and NPV are showing loan financing, grant financing, and carbon offtake. Then down here we have a little interest rate sensitivity calculation just to show what different interest rates do to the project economics. And you can see, within sort of a reasonable bound, it doesn't significantly change project economics. So a 1% interest rate has the IRR at about 26%, while a 10% has it at about 22%. So interesting to think about definitely matters to project economics to a certain extent, but may not make or break a project unless margins are pretty thin. So that is the financial model in its entirety. Please feel free to reach out to myself or the folks at the Cash Coalition if you have any questions about how this works, if you have any suggestions for improving it, or if you'd like to get access to this financial model to be able to play around with it yourself. Thanks, everyone.